All right, let's dive right into this explainer where we run the software giant Synopsys through the ultimate, rigorous stock valuation gauntlet. As an investment analyst, my job isn't to just buy into market narratives, it's to break down the hard math. So today, we're putting Synopsys, ticker symbol SNPS, to the test using the timeless methodologies of the world's absolute greatest investors.
Here's our roadmap for today. 1. Company snapshot. 2. The Buffett lens. 3. The Lynch lens. 4. The Graham lens. 5. DCF and alternative models. And 6. Synthesis and final recommendation.
Section 1. Company snapshot. Setting the stakes. Okay, so Synopsys is an electronic design automation behemoth. They basically lead the charge in the software that engineers use to design and test integrated circuits. But right now, it's trading at a massive share price of $480.64, carrying a sky-high trailing PE ratio of 119x. The market is pricing this company like an absolute rocket ship. To put that 119x multiple into some simple perspective, if the company's earnings never grew from today, it would take you 119 years just to earn back your initial investment. That is an incredibly steep premium.
Now, Synopsys does have some incredibly ambitious explicit guidance for fiscal year 2026. They're targeting approximately $2.0 billion in free cash flow and a midpoint non-GAAP EPS of $14.76. This is largely driven by strong business performance and their massive integration with Ansys. But as analysts, we really have to ask ourselves, is this projected growth actually enough to justify that 119x multiple?
Section 2. The Buffett lens, moat, and management.
Let's step into the first chamber of the gauntlet and see if Synopsys has the kind of economic moat and fortress balance sheet that the Oracle of Omaha demands. Well, it easily passes the moat test with incredible recurring revenue. Looking at their Q4 2025 financial supplement, recurring revenue makes up a rock-solid 78% of total revenue. However, it completely fails Buffett's strict debt criteria. If we glance at the balance sheet, they're carrying a heavy $10 billion long-term debt load. $10 billion in debt compared to just $2.5 billion in cash. Definitely not the fortress balance sheet Buffett looks for when picking his investments.
Buffett also loves looking at owner earnings, which actually aligns really nicely with the company's robust $2 billion free cash flow target. The cash generation here is undeniably brilliant. But Buffett also demands a margin of safety. He wants to buy businesses for less than they're intrinsically worth. As an investor, your margin of safety is your ultimate protection against being wrong, right? If the market turns or growth slows down, that discount is what protects your capital. Finding any sort of margin of safety at the current $480 share price is a severe challenge.
So the crucial point is this. If Buffett might pass on the price due to the heavy debt and lack of a margin of safety, would a growth-focused legend like Peter Lynch be willing to pay a premium for this tech stalwart?
Section 3. The Lynch lens. Growth versus price. Entering this chamber, we have to weigh Synopsys' impressive growth narrative against its staggering market valuation. Lynch loved fast growers and stalwarts, for sure, but he outright refused to overpay for that growth. To do this mathematically, we look at the PEG ratio, a metric Lynch popularized to identify when a fast-growing company is actually fairly priced. Think of it as a reality check for high PE stocks. A PEG of 1.0 is considered fair value. Anything under 1.0 is a bargain.
Let's actually run those numbers. The company is targeting EPS growth in the high teens. Assuming an optimistic 18% growth rate based on management's targets, we divide the 119x trailing PE by 18. That gives us a PEG ratio of 6.6. Remember, Lynch preferred 1.0. At a PEG of 6.6, Lynch wouldn't just walk away, he'd probably run. Even factoring in the anticipated 1476 forward EPS, the forward PEG still hovers well over 2.0.
Section 4. The Graham lens, the mathematical anchor.
This is the strictest chamber of all, where Benjamin Graham's defensive investor checklist strips away all the hype, ignores the future promises, and focuses purely on the hard math of today. While Synopsys has the massive size and stability Graham requires, it completely fails the financial condition and moderate pricing checks. We have to look really closely at the recent margin compression down to an 8.9% trailing net profit margin. Plus, trailing earnings were heavily distorted by a $313.5 million one-off gain. Graham absolutely hates paying 119 times earnings and roughly 3 times book value for compressing margins. Why? Because you're essentially paying top dollar for a shrinking slice of the pie.
Let's look at Graham's intrinsic value formula in action. It's actually a beautifully simple calculation we can walk through together. We explicitly plug in that $14.76 target EPS and the roughly $159 book value per share. That book value is derived directly from their $30.47 billion in total stockholders' equity divided by roughly 191.4 million outstanding shares. We multiply those two figures by 22.5 and then take the square root of the result.
The calculation outputs an intrinsic value of approximately $230. When we drop that anchor against the $480 trading price, it reveals a stark lack of a margin of safety. In fact, Synopsys is trading at more than double what Graham's formula suggests is a fair, grounded price.
Section 5. DCF and Alternative Models.
Leaving the classic gurus behind for a minute, let's stress test the raw data using pure modern financial forecasting, stripping out any historical biases. We'll build a base case discounted cash flow model around that $2 billion free cash flow target. Now, because corporate filings don't explicitly state their internal discount rates, we as analysts have to make some educated assumptions. So we'll assume a standard 10% weighted average cost of capital and a healthy 3% terminal growth rate to reflect their wide moat in the semiconductor design space, all while forecasting an aggressive 18% growth over the next 5 years.
When we run a sensitivity table varying those assumptions, like flexing the WACC down to 8% or bumping terminal growth to 4%, the math shows that even in highly optimistic scenarios, the DCF fair value just struggles to justify the current market premium. You essentially have to assume near-perfect operational execution and zero macroeconomic hiccups for a full decade just to make the current price make sense in a DCF model.
Furthermore, looking at alternative comparable models, Synopsys' 119x trailing multiple wildly outpaces both the broader software industry average of 28.5x and its direct peer group average of 34.6x. The market is pricing in a level of dominance and growth that leaves absolutely zero room for error, which is not exactly a comfortable place for an investor to sit.
Section 6. Synthesis and Final Recommendation.
We have successfully run the valuation gauntlet. This summary table brings it all together, showing that whether you use Buffett's margin of safety, Lynch's peg ratio, Graham's strict mathematical anchor, or a modern DCF model, the fair value estimates consistently flash red at current levels. Literally not a single historical framework supports buying at nearly $481 a share.
Objectively balancing the reality of this business, Synopsys has incredible operational strengths. It is undeniably an amazing company with a wide moat, a robust $2.0 billion target cash flow, and 78% recurring revenue. But as an investment, those strengths are currently heavily counterbalanced by a stretched valuation, a $10 billion debt load, and recently compressed net margins hovering around 8.9%.
Therefore, our impartial recommendation as analysts is a hold or sell at current heights. It's a stellar business, but a dangerous stock price. Our aggressive buy triggers sit significantly lower to satisfy these rigorous valuation frameworks. And it's absolutely crucial to remember these are triggers, not price targets. They represent the exact disciplined threshold where the math finally works in your favor. We'd want Graham's price below $153, Buffett's entry below $250 to ensure a true margin of safety, or Lynch's peg to drop below 1.5. I'll leave you with this final thought to consider before buying into any high-flying market narrative without doing the underlying math. When a great business is priced for perfection, who pays the price for the slightest imperfection? Great companies don't always make great investments if you pay the wrong price. Keep this explainer in mind the next time you see a 119x multiple, and I'll see you in the next one.